welcome to the Inflation Nation. Welcome to another edition of Wealthy and Wise Wednesdays, my weekly podcast where I share information to help you take back control of your financial future. I'm Ron Sneller. Today is Wednesday, April 10th, and welcome to the Inflation Nation. You know what, guys, listen, I've been saying for months, if not years now, that you need to get used to higher for longer interest rates. All of this nonsense, all of this garbage coming into 2024 was that the Federal Reserve was going to cut interest rates up to 7 times this year. The data never suggested it. Listen, at the end of the day, and we know that some of this data is manipulated, but at the end of the day, the American economy has been resilient. Unemployment's only at 3.9%, and that fluctuates a little bit, but it's still under 4. We're seeing a lot of strength in the labor market. Again, I think some of that data is a little bit misleading, but the American economy has been resilient. And today, some of the inflation numbers came out, and I'm going to read a couple of them to you here. But the inflation numbers came out, and we actually saw an increase in inflation. Let's go through this. The cost of consumer goods and services rose a sharp 0.4% just in the month of March. Okay. That caps off a third straight month of elevated inflation readings. That's going to make it really hard for the Federal Reserve to cut interest rates anytime soon. Right. Let's talk about the increase in CPI over the last 12 months, 3.5%. So it rose from 3.2%, and that 3.5% reading is the largest reading since last September. And then, finally, core CPI climbed 3.8% in the last 12 months. Now, with this increase in CPI, they're saying that it's the cost of energy and the cost of shelter that accounted for more than half of that increase. But guys, listen, at the end of the day, inflation is a lot stickier than what they expected. We have to be prepared for higher for longer. So what does that mean for you? This inflation and therefore the higher interest rates, it could be a positive or negative depending on where you're at, right? If you have debt, especially if you have variable debt, that's the thing that you need to do is you need to get out of debt, right? Because these interest rates on your debt, they're going to remain sticky. They're going to remain higher for longer because of this inflation. They can't cut interest rates or inflation's going to reignite out of control, right? So that 3.5% that it's at right now, that's a far cry from their 2% target. So they can't cut interest rates right now or inflation spikes out of control. So if you have debt, that's probably one of the very best things that you can do right now is pay down that debt. So if you're a debtor, you're in trouble, right? But if you're a saver, you shouldn't be worried about these higher for longer interest rates. You should be enjoying this. I mean, think about this. Like my money market account right now is at 5.5%. I put a lot of money into cash value life insurance and whole life policies, mutual whole life companies. When the interest rates are high, their investments perform better, which means dividend rates are better. So, right now, my whole life policies are performing better than they were 3 or 4 years ago. I love that, right? So right now, if you're a saver and you can save money, you're actually making a good amount of interest on your safe money vehicles again. So I think that's absolutely amazing. And so one of the things that personally I'm doing, yes, I'm saving money. We got money in the money markets. That 5.5%, that will be temporary. That's not a long-term play for me. At some point in time, they will cut interest rates back down. But right now, I'm using that as a storage tank for my emergency fund is there, but also I'm using it as a storage tank as I save up money for these quarterly insurance premiums. I save it up there. I collect 5.5% interest. And then when it comes time to make the insurance premium, and actually, I think I can make another one. I made my wife's last week. And then I have one for my policy tomorrow, but I save it there where it's earning 5.5%. Then we transfer it into the insurance where we get that competitive rate of return, but we also have the tax advantages and we can leverage it and borrow against it. Right now, I'm in the process of buying a turnkey rental property, and that's where I source my down payments from. It's like I borrow the money from the insurance policies and use it to make the down payment. And then I get bank financing for the rest of it. So quite literally, I have none of my own money in the deal. The down payment is the insurance company's money because they're giving me a loan using my cash value as a line of credit. So I'm using the insurance company's money for the down payment. The bank's money to cover the rest of the mortgage. I've got none of my own money in the deal, right? And the thing that I like about the insurance is right now I can borrow from my insurance policies between 5 to 6%, which is sure as heck beating credit cards. It's beating home equity lines of credit. So even though we're in a high interest rate environment, borrowing rates on insurance policies are pretty low, comparatively speaking, right? And so that extra money that we then bring in from the business and as the rentals kick off cash flow, I'm just using it to then pay down those lines of credit, which really just increases my liquidity, increases my borrowing capacity for the next deal. So with some of these turnkey rental properties, and personally, I'm looking to target some of these smaller, or I should say, like the markets in the Midwest that have smaller prices, right? Like maybe they're buying in Detroit or Memphis or St. Louis. They're buying houses and then they're rehabbing them. They're putting a tenant in there. They're getting the property management in place, and then they're selling it to investors like myself. We're getting ready to buy a house in Detroit, and I'm able to get an 11% cash on cash return, and I only need to come out of pocket for about $35,000 for the down payment and the closing costs, right? And if we can collect one of those types of houses, I don't know, maybe twice a year or maybe once a quarter, if business here is going really well and we're bringing in that revenue, I think that can be an amazing long-term play to have the potential appreciation of the house, plus the mortgage pay down, plus the depreciation, plus the cash flow. So the real estate in itself is a tax shelter. The life insurance is a tax shelter. We're kind of operating as our own bank and building tax-free wealth in two of those vehicles. So again, guys, just getting back to this inflation, the interest rates higher for longer, find a way to take advantage of it, pay off that high interest debt if you have it. If you are a saver right now, as you're saving that money, you're getting a good interest rate. So while you look around and you're picking and choosing like what is going to be the next investment, maybe real estate's not that your thing. Like I'm not giving investment advice that you should go buy physical real estate. I'm just giving education. That's all this is education. This is not advice. But while you're saving up to tackle your next opportunity, you can at least get some good yield on your safe money instruments again. Well, listen, guys, that's all we have time for here today. I hope this was helpful. I would love to hear your thoughts, your questions down in the comment section there. Let me know, what do you think about inflation? What do you think about interest rates? What are you doing to protect yourself, but also to take advantage of where the economy and where the interest rate environment's at today? I'd love to hear from you. All right, guys, thanks for tuning in, and we'll talk to you later. See ya.